On the podcast with us today is Vikram Raya and Ravi Gupta. So glad to have both of you gentlemen here with us on the podcast. Looking forward to diving into this property that we're going to be talking about today. But before we get started, before we dive into this property, I want you to talk to us a little bit about yourself and your background and where you are right now as far as the multifamily side of things is concerned.
So my name is Vic Raya. I'm with Viking Capital. And again, I'm so glad to be on your podcast, Dan, and also be with my buddy and good friend, Ravi, as my co-founder of Viking Capital. And yeah, we're just, we started our multifamily company, 5-6 years ago. And now we've, grown to about 2,500 units, close to 3,000 units. And just trying to buy 4 or 5 deals a year, buy good properties, attract top quality investors, and do good returns for our investors and our partners.
Yeah, and thanks, Vic. Yeah, and really a pleasure to be here, Dan. So Vic and I, we met probably about 6-7 years ago, and we discovered we had very similar interests. We both had an interest in real estate. We did private, small deals back in the day where we had some personal holdings. And then we decided to come together and grow this to another level. So that's when we started our multifamily syndication business back in 2015. And then it just took off from there, as Vic mentioned. So in our future, we're really focused on acquiring deals the next year. We think the numbers look good to us, and we're focused on growing.
Awesome. Well, let's go ahead and dive into this acquisition that you guys acquired last year. It's called Veritas. Is that correct?
That's correct.
That's correct. And where is this one located?
So this is, it used to be called Bella Grande. So those of you that know Marietta, it's located in Marietta.
And Marietta, for those of you who don't know where Marietta is, or if you're from Marietta, it's Marietta. It's actually in Atlanta, Georgia, one of the submarkets inside of Atlanta, Georgia, in the northeastern part of Atlanta, Georgia there. And how many units is this property?
It's 192 units.
192 units. And let's see, let's first kind of dive into how you found and how you sourced this deal. Okay,
Vic's got a great story here, so I'll let you go, Vic.
So Dan, again, Atlanta's a competitive market, and people are looking for deals in the Southeast, and I think we're all friends, but we all sort of sometimes even friendly compete on deals, and so it's really important that broker relationships have to be formed. And it took me 2 years to convince a group out in one of the broker groups in Atlanta to eventually send us a deal that actually was worth our time after we've underwritten like hundreds, so, and we've grown from there. And now we're like, all right, like, how do we keep going? And it was sort of a quiet time for us because we didn't have a deal for like at least 6 months. And you know how that is, you get this deal angst, and you're like looking for the next deal, maybe if I could just twist and turn these numbers, they can make it work. But that's why I think multifamily is a team sport, and you've done a good job, Dan, with, you have 2 other guys who can trust and check and verify your numbers and make sure that when you do take on an acquisition, it's the real deal. So, Ravi was making sure like the numbers work. So I told Ravi, look, I need to just make something happen. And so I just got on a flight. We live in Northern Virginia, DC. We got on a flight, and I was like, you know what? I need to just go meet with all the brokers, and I need to sort of shake the tree, if you will, and see if we can get a deal to come out. And so I flew down there, and my dad picked me up from the airport, and I didn't tell him to go home. I told him, take me to the liquor store. And, and so he's like, why do you want to go to the liquor store? I'm like, don't worry about it. So we got there, and I made some purchases, and I loaded up the trunk, and then, came back home. The next morning, I had appointments with the top 5 brokerage companies in Atlanta for multifamily. And literally I went from, office to office, had some lunches, had some dinners, had some coffees. And in each meeting, I would meet with the top broker there who had like our asset class, essentially, which is like maybe 150 to 300 unit, apartments that we were trying to buy. And I would meet with them, and then I would give them a bottle of Dom Perignon from my trunk, and I'd be like, "Hey, this is to celebrate our future deals together." And literally 2 weeks later, I had 7 deals in my inbox. And again, our underwriter and Ravi and we just went through it all, and then we found one that really worked. And Veritas was the one that we really liked. Very competitive. We had to compete against, I think, 7 to 8 groups. Got into best and final. I don't think we were actually the top group, but then some insider information from the broker allowed us to get the deal finally.
So that's a great story about how you were able to kind of, even though you'd spent some time before building relationships with these brokers, it took just a little bit of an extra nudge to kind of say, hey, I want to go ahead and celebrate now this next deal. So I'm curious, have you seen any other deals come from those relationships so far that you have been able to continue to celebrate? Yeah,
absolutely. Ravi and I, we're about to close on our biggest deal ever, which is called
Mirabella
Place in Atlanta, and it's a $53 million deal. 368 units. And it's all from those kind of same relationships that we've been forging. So I would say, as you know, Dan, relationships. That's the key to this business. And it's just, even though there's so many people, quote unquote, in the business, it's a really small group of people that do this.
And just to add to that, it was kind of a funny story as well. The Veritas deal, which was previously known as Bella Grande, we were right there. The seller was about to accept our offer, and then another party comes in and just offered all cash, $500,000 more than we were going to pay. And the broker comes back to us, is like, "Hey, look, we got this 11th hour player. Are you able to match this?" And we were just like, "Okay, come on, this is like, you're pushing us to the edge here." But we wanted it. We agreed to those terms. The party that actually put an offer on Veritas and made us pay that much more, or one of the partners, Dippin, is partnering with us on Mirabella. So we're actually together now buying this other asset. It's funny how that all works out.
Well, and it's interesting because when it comes to these relationships, it's not just when they're going to send you a deal. It's when they can actually, when you're not on the phone with them, when they're talking to that seller, talking you up and saying, "Hey, this deal, this particular buyer group is legitimate. They do what they say they're going to do." And I would feel very confident with you in, awarding the deal, and for that broker to stick their neck out on the line for you and talking you up is extremely important. That's one of the ways you get a deal, even though you're not the top bidder.
Absolutely. And, the interesting thing is we found many of the deals that we've acquired, we were not the number one. There was somebody else, our first deal, somebody else, it was awarded to somebody else, and then they backed out for whatever reason, and then we got it, and it happened multiple times. So, a lot of people feel that, hey, look, man, number two, that's I'm done. But 20% of the time, those deals actually work out.
Well, we definitely have a lot more in common than I think, because our very first deal was the same way. We got our deal. They passed on us and went with another buyer, and same thing. That other buyer couldn't perform, and so they came and asked us if we wanted it, and we took it down too. So that's pretty cool. Yeah. So on this particular acquisition, it was sent to you via the broker. A couple other groups had bid on it and were kind of in the runnings for it. At what point during the process did you go down and tour it? And was it just one of you, or was it both of you that went actually tour this before putting the LOI on the property?
Yeah, Vic, you toured it first. Yeah, I toured it initially. We also have a lot of other boots on the ground. We have other team members down there, so they would tour it. One of the things for people listening is when you tour something, there's good for the partners to tour for sure, because it shows legitimacy to, one, the broker, and number two, it shows legitimacy to the sellers, because there's a lot of people who do absentee LOIs, just throw an LOI out, and no one is even on their team has even gone down there. So that's one. Number two, you want to have your property management company, the one who's going to take over the property, unless you do in-house, tour with you, because they're going to give you a really good Capex. They're going to be able to give you some, approximations on how to tighten your underwriting. That's going to help you in a couple of ways. If you know all this going in, maybe if you want to be competitive on terms, you can talk about shortening the due diligence, or you can play with that a little bit. And number two, you can just assume what's the most you can pay for the deal. And finally, when you feel comfortable going after a little bit more aggressively.
Those are great tips. And once you toured the property, how soon after you toured it did you put the LOI on the property?
Well, I think when Vic went down originally, he toured multiple properties at that time, and then when he came back from his trip, we placed the LOI pretty soon after that tour, that initial tour, and then I went down there subsequently to verify things. Verify it all made sense to me, and then we agreed on the terms, and then went for it.
Yeah, and one of the things that, for those of you who are listening, you need to realize is that when you get into the larger multifamily space, it's not just like in single family where a bunch of people submit offers and they just choose one. There's usually a process that goes through. So it's usually everybody submitting their LOIs. And right now, with the way multifamily is, there's usually between about 20 to 30, sometimes 40 or 50 offers on a property. And then the seller and the broker will get together and choose the kind of the top 5 to 7 to kind of bring into the next round, which is called the best and final round. And that's when they go back to the buyers and say, hey, this is kind of the range of the bids. Do you want to tighten up your offer, kind of get to the next level? And then they'll bring you in for what's called the buyer interview calls. And those buyer interview calls, they start off by giving you this long 6 to 7 page questionnaire that you fill out that the seller wants to see, and also the broker wants to see. And then they will invite you, if they want to bring you to the next level, into a buyer call, and where they go through those questions. And one of the questions that has shown up on every single one of those buyer interview questionnaires that we have received is, have all of the partners toured the property, right? And that's where it's important, like Vikram said earlier, that you have to make sure that the partners go down and view the property. And I know that there are some groups that say the partners never go see it. They don't want to have the bias of feeling the property or anything like that. They just want to see the strict numbers. But I still like going to the property and having that tour of the property and making sure that we can check that box on that buyer interview questionnaire that the partners have actually seen that property when we acquired that. And I'm sure you guys have seen that same question on those questionnaires as well.
Oh yeah. 100%. I mean, that's why it's so important for us to tour the properties ourselves. And then also you get this gut feeling, right? I mean, you look at the numbers, some things may make sense, but when you go tour a property, you get your hands on it, you check it out, you get this gut feeling and it's going to work. And that's, a lot of what we do. A lot of it is numbers driven, a lot of it is objective, but there's that subjective component. And it definitely makes sense. Like this deal made a ton of sense to us when both of us went down. We're like, we love it. And it worked out great.
And then I also want to add that you got to shop the comps. So the broker does his job of padding up the OM, which is offering memorandum. And, people are like, hey, yeah, look, you got $200 headroom. You can really raise rents, but there's nothing that can beat you pretending to be a tenant and going next door, looking at that property and saying, okay, what were your rents? Okay, got it. Now I'm going to go to the next one, and then making a little matrix or a table, and then okay, what is the realistic opportunity here that we can really raise rents with our capital expenditure?
So depending on the property, you don't normally dress like you're dressing right now, do you?
Yeah, you gotta wear the. We got our Viking capital hat. You put it on backward and just go for it.
I usually go shirtless. I mean, that's just my
That's funny. Those secret tours are always kind of fun to be able to pretend that you're a resident there, looking at the properties. One of the things that I've actually found recently is a lot of these property managers that are working on sites with some of the comp properties. They're usually willing to answer questions about the property, even if they know you're a competitor property. Because we've actually toured properties before, and we're like, hey, we can't tell you which property we're looking to acquire, but we're actually looking to acquire a property. We wanted to ask you some questions about your asset and the performance, and get a tour of your model. And we've always had a lot of openness when it comes to those the property managers giving us a lot of that insight and feedback.
Yeah, that's absolutely true. They're willing to share info. I mean, we kind of have fun with it too. Sometimes we'll make up the manager at the local Target, or, I'm working at, my brother's moving into town and he's in school. Like we'll sort of make up stories sometimes just to have fun with it. But yeah, they'll give you all the info you need. Yeah, absolutely. We've had good success.
So one of the things, and I know Atlanta is notorious for this right now because of how hot the market is, and most markets in the country that are, any semblance of hot are requiring hard money day one. So walk us through what kind of hard money what was required day one on this particular property. And for those of you who are listening, when we say hard money, we're not talking about them getting a hard money loan or anything like that. We're talking about the earnest money deposit that goes non-refundable day one. That's what we would consider hard money day one. So walk us through that process and the terms that you guys set out for this particular deal.
Ravi, do you remember what it was on this one? But we were very aggressive. I think that's what helped us win it.
Yeah, we were very aggressive on this one. I think, in fact, we offered more earnest money than any of the other competitors. We had like about $200,000 hard day one, and then another $300,000, after the feasibility period expired. So those were our terms. You're absolutely right, Dan. The way these properties, the desirability, the demand of these, getting these multi-unit properties now, the multifamily properties rather, it's so high that you have to put money hard. And the way you feel comfortable with it is as we mentioned before, you've already toured it. You go with a property manager that knows that property really well, and you're comfortable with it from the get-go. And that's the only way you can put that hard money down. If there's a question mark in your mind, then you may lose that money. Now, it's sort of a gamble, right? You put that money down, you're hoping everything works out. If you find structural issues or something like that, you may be in trouble. But sometimes you can get early access to a property, get an access agreement, where they'll give you that access. So, while you're preparing the purchase and sale agreement, you can do some of that work. And then, hey, look, this may not work. We found something that's, concerning, and then you can back out and save your hard money. So that's a way to, kind of skirt around that hard money issue.
And one other kind of tip of advice here as well, we're talking about the kind of the what to put inside of the PSA or even inside of the LOI when you're talking about the hard money day one. One of the things that we always do to kind of mitigate any type of risk when it comes to major structural damages that are going to cost, sometimes millions of dollars to fix, depending on the size of the property, is we actually have a clause in there that basically says that we are able to retrade if there is any type of structural damages or any discrepancies or anything that comes up in due diligence that would cost over $100,000 to fix. Because if it's under $100,000, for the size of the deals that we're acquiring, it's not going to make or break the deal, right? You have to spend $20,000 or $30,000 to repair a few things here and there. It's not a very big thing, very big deal. But if you get into something and there's some major foundation issues or structural damage or something like that, it's going to cost over $100,000. It could be, depending on the size of the damage, could be something that can make or break it. And those are some additional things you can add inside of those terms to make sure that you can mitigate any of that when it comes to the hard money. Now, some of these sellers might not want to do that, so it's just kind of it's a thing that we always add in there. We so far haven't had any pushback on that. Mostly, I think, because most of these sellers are pretty confident with their properties as well. They're not worried about something like that coming about. But we have only really retraded on one deal, and it had to do with COVID-19 is what it had to do with, and the 10-year treasury dropping and the debt matrix changing and stuff like that. But those are some additional things you can include inside of those hard money terms.
And then I wanted to comment, there's 50 shades of hard money. So
that's true.
You can, there's hard money 2 weeks after the PSA signed. There's hard money day after PSA signed. There's hard money after LOI signed. So there's a lot of ways you can frame it. What we found as, it's a competitive market, but it's not cutthroat, I guess. We do maybe between 3 to 7 days after PSA signed. So if we have an early access agreement, essentially we get a very quick due diligence, and then our money goes hard. So we are able to pick up all these kind of any major red flags.
Yeah,
and
that's
something
pretty smart.
Something to add there as well is sometimes some of these sellers, they don't really care as much about hard money. as just shortening the due diligence terms and getting the deal done. We've seen that a lot, actually. In fact, some of these sellers want, typically it's like 60 days to close. They want 45, and that's more important to them than that hard money. So it's just you can go either way sometimes. Like if you're like, hey, look, I'm not going to put much hard, but I'm going to close on this deal in 40 days, and then that may make sense for the seller.
Yeah,
we're actually selling a deal, Dan. But we're selling a deal recently, and we took an offer that was really not about hard money, but it was about like certainty of sale, and it was about that shortening of some of that due diligence. Yeah, that was important to us.
Yeah, and the biggest challenge right now, the shortening of the due diligence, is really from the financing perspective, because Fannie Mae and Freddie Mac right now, the agency lenders they're taking a good full 60 days on a lot of these loans to get them done, unless you're a preferred borrower with them. But of course, bridge loans are a lot easier to do with that. And one of the things that we got one of our very first large deals, or not large, but really large deals, it was over 50 million, was actually bought in October of 2019, and we got awarded that deal because originally we had 30 days to close. 30-day due diligence and 30 days due diligence and 30 days to close, with no options to extend. And the seller said, if you do a 21-day due diligence and a 30-day close, which is basically 51 days, then we'll give you the deal. And that was one where we actually had 600 hard day one and 600 after due diligence. And they awarded us the deal, and we got it done in 50 days, right? But it was a bridge loan, right? So the bridge loans and the bridge lenders are a little bit easier to close a lot faster than the agency lenders. But when it comes to the agency lending, unless you're a preferred borrower with them, it can be a little more challenging to tighten up some of those terms.
Absolutely.
That's interesting that you're talking about bridge. So I think for a lot of those future syndicators out there, or current syndicators, sometimes bridge is an option for if you're going to refi in a year or two, if you know that maybe you need some help raising the Capex money and you don't want to raise it, separately, then the LTV or LTC options are there, even though the interest rate may be a little bit higher. And so I think bridge is a good option. And in this deal, the Veritas we're talking about, Dan, we actually ended up using a very unique debt option. We actually went with Cmds. I'm going to let Ravi talk about that.
Yeah, let's dive into the financing. That was going to be my next question on here. So let's just do it.
Yeah. So so CMBS used to be more popular, I think, maybe pre-COVID. Post-COVID, CMBS has had some issues in lending, and they were very competitive at that time. We closed on this deal. It was back in 2019, and we didn't have any experience with CMBS prior to this. And our debt broker at the time was, he was like, hey guys, what about CMBS? And I was just like, no, I'm not familiar with it. I've heard horror stories about CMBS. They're putting lock boxes on things, like springy lock box, this lock box, that lock box. I'm like, I don't want to deal with it. And then he would, we'd have a conversation. He's like, hey, what about CMBS? And then I'm like, no. And then he asked over and over. And I got to the point where I'm like, stop asking me about CMBS. Like, why, what is your, are you getting some bonus? Like, be honest with me. Are you getting extra? You getting paid extra for the CMBS loan? And I'm usually a pretty calm guy, but Vikram, you're in the room with me at the time. And I was just like, I was like almost foaming at the mouth. I was like, this guy is just not letting me get out of this.
Get my agency loan. I'm like, give us our agency loan.
So then, so we were at a conference at the time, and it was Dave Lindahl conference, and Bob Bowman, who he's you may know him. This guy's the most detailed guy, one of the most detailed guys I've ever met. So he was at the conference. I was like, Bob, this guy's been bugging me about this CMBS loan, and you've done it before. Let's talk about this. So we literally spent like 2 days of the conference. We just talked about the CMBS loan. We talked about every aspect of it, and we hit up our broker and asked all these questions. At the end of the day, this loan was amazing. It was, we actually there's no reserve on it. The interest rate was lower than agency debt. We had more of an LTV than we did with agency. We had I think over $1 million of more proceeds. And then we have a 10 years interest only period. I mean, it was just an unbelievable option.
10-year interest only.
10 years interest only. So We were just like, okay, this makes all the sense in the world. So once we got comfortable with it, we went ahead with it, and it was great. It was great working with our broker and getting this deal done.
What kind of prepayment penalties did you have on it?
It's defeasance.
Is it step down or defeasance?
No, it's defeasance. But then also you can assume. So with CMBS, you can negotiate every term of this loan. So there is an assumable. Anybody can assume this loan. So that's sort of our exit strategy, is a loan assumption, or just kind of hold it to full term. But that is the prepayment.
But full IO is pretty good for anyone wanting to assume. Yeah.
Yeah.
Oh no, that's great. That's one of the longest IOs I've seen. So that's great.
Yeah, it's like unheard of. I mean,
yeah.
And again, that was negotiated. It was initially a 5-year. What happened was it was a 5-year IO, and then they backtracked. And this happens with CMBS loans. They can, like, the 11th hour, they can be like, hey, look, sorry, the interest rate has changed. It doesn't make sense for us at the previous interest rate. They retrade, and that's what I was scared of. But our broker was such a badass. He negotiated with them, and he was like, this is not fair, and a lot of back and forth. And he got us that 10-year IO in exchange for increase in I think it was 12 basis points.
Wow. What was the final interest rate on it?
It's 4.
And is it floating?
No, it's just 4 fixed for the full term.
4% fixed, full term, and 30-year AM?
Yep.
Okay. And what was the loan to value or loan to cost?
I think it was 75.
75. Yeah.
That's great. That's a great deal. So since this one that you've done, have you considered doing CMBS on any of your future acquisitions?
Well, the CMBS market isn't really there
during COVID. Yeah.
Yeah. So
I think it was just the best of. It was just like a perfect storm that agency had pulled back, CMBS had pulled forward, and it just seemed to work. I don't know if CMBS is a long-term kind of option for most people, and especially as we get bigger deal sizes now, into the $50 to $100 million range. I think agency is still going to be the best game in town, and maybe establishing as a preferred agency borrower is the way to go.
And they were so competitive at bottom of 2019. They're super competitive. I mean, they're beating out all the agency terms. So it made a lot of sense then, but moving forward, it doesn't. We would be open to it. I mean, if there was an option, we'd be certainly open to it.
Have you guys looked into or done any research on bridge to HUD financing?
We do have one HUD loan in place, but we haven't looked into bridge to HUD much.
Okay. Yeah, that's one that I interviewed somebody on the podcast, I think two episodes ago, and he basically acquired a $62 million property and raised about $14 million in equity, which I thought was pretty low, but he got 84% proceeds, and he did a bridge to HUD financing, and the HUD financing is the interest rate is fixed for the full term, but it takes usually 4 to 6 months to get it in place. And so you have to use a bridge loan first to acquire, then you roll it into the HUD financing, and they get 35-year amortization, which was pretty cool.
Yeah.
There are some other stipulations with those types of loans that he mentioned about they only allow you to do distributions to the investors twice a year. So there's some limitations there. There's some extra reporting requirements and stuff, but I thought it was an interesting debt product to kind of research.
Yeah. We've got a HUD loan on one of our assets in DC, and I mean, you just can't beat it. For all the reasons you mentioned, that it's incredibly low interest rate. It's fixed for the full term of the loan, 35-year amortized. Yeah.
So no penalties usually after the first 10 years to be able to get out of the loan either.
Yeah, exactly.
This was a $20 million project, mid-rise, Class A building, 49 units in 3 miles from the White House. We bought it, and it was back in the day before this craziness of the interest rates being this low. We thought like kings of the mountain, 3.2%. Yeah. And then we're like, oh, it's not that great anymore. And then we ended up actually, Ravi found a loan group to work with. So we're refinancing it from 3.2 to 2.6, 35-year AM and term. So it's gonna be a great long-term sort of a legacy kind of product. if we can figure out how to eventually refi the investors out a little bit.
Yeah, that's awesome. So talking about this particular property again, let's kind of going back to it. We kind of went on a few tangents, which have been great. But what kind of things came up during your due diligence process here that might be interesting for us to kind of talk about?
I think when I look back at the due diligence for this property, it was so smoothly. It was just this one was really one where every step. Aside for this, that whole Cmds debacle, which actually ended up working out, but every step was very smooth. I mean, when we went there for our due diligence, we basically had, I think it was like 10 different teams of contractors, and they all went off their separate ways, looking at, roof replacements, looking at the interior renovations, looking at asphalt work. We were looking at we redid a whole sport court area. So we're getting bids on everything all at once. Our property management team walked every unit. We walked just a few select units, and we've developed a relationship, a good enough relationship so that we trust their reports. So we don't necessarily walk every unit. It was a very smooth process. So not a whole lot came up, and luckily the property management team that we have on board now, we're managing it. But with the prior seller. So it worked out. It was a nice transition.
The big thing, Ken, was we were worried that, our Capex budget for this was a $26 million project. It was starting to get up there, and, people were saying vinyl's out. You got to do hardy plank. And then we're like, wow, to do hardy plank for the whole complex, that's going to be a lot of money. And then we had to have roofs factored in. So it was a heavy Capex lift for us. And then we're doing some interior renovations, plus we're doing a whole exterior amenity space. And this is before COVID, so we were just doing the exterior amenity outdoor courts because it made sense for that property. But in the end, it actually was a perfect kind of amenity to have during the COVID situation. But though we spent a ton of money, if you go look at the property now, it looks completely brand new. We've probably anti-aged it 10 years, maybe 15 years. And I think it's going to sell. It's going to show well. It's attracting higher level tenant base, and it's going to probably sell for a premium. So it was worth the expense to put in the hardy plank and the roofs and all those stuff we've done.
What kind of rents, or kind of like, what would you say were the average rents on the property
at the time of purchase?
Yeah,
probably a little under $1,000.
And where are they now?
Now we're getting probably average for the new leases. We're hitting like 1,100.
That's great.
Yeah, it's really bumped up. I mean, we got like $400 rent bumps in some of these units. It's insane. Doing really well there.
What kind of renovations did you do on the interiors?
So we're doing new flooring, new countertops, new cabinetry. New paint, new doors, new appliances, and it just shows really nicely.
Mm-hmm. Yeah. What was the total Capex budget for the interior renovations? Not like it's just the per door.
Originally it was actually $12,000 per door, but then the prices have gone up since we closed on it. So we're now $18,000 per door.
Okay, that's a pretty heavy lift.
Yeah.
And on the exterior, I love the hardy plank. That was a great decision there. You looked at a few assets where they were still vinyl, and if you could take down that vinyl and wrap it with the hardy plank, it really modernizes the exteriors of the property. So I do like that decision quite a bit. What was the exterior budget overall?
So for the roof replacement, it was around $250,000. Mm-hmm. For the hardy plank exterior is around $700,000.
Okay. And how long did it take to complete those projects?
So this is the other thing that went really well with this project. We executed just, beautifully on this one. We closed on it in December, actually finished the roof replacement before the year ended. So closed early December, finished it in like a couple weeks. And then we did the hardy plank next and finished that probably in July of last year. So it's like a 6-month process. And then the interior renovations are ongoing. The sport court has finished probably October of last year. Mm-hmm. And really all that's left, we've actually completed almost everything but the office space. And we're going to make the office look just great. We're going to add we're going to build it out so there's like a rentable space in there too. So it's, an additional income generator there. And that should be done in maybe a couple months at most. And then we're done with our business plan.
So that's awesome. That's awesome.
Dan, have you found that when you talk to other syndicators and things, this seems to be one of the good strategies is outside in. What are your thoughts on that?
I agree, because that's what's going to attract the residents, and you can do you could do the model unit and renovate that and show that to actually show the prospective resident what the interiors look like, even though you don't have all of the interiors done, right? But it's great to have that kind of exterior done first, or at least doing that while you're doing the model and doing some of the interiors. But to just do all the interiors first and then do exterior, I don't agree with that. I would definitely say exterior first and then the interior.
Absolutely.
Yeah. So talk to me as we're wrapping it up here about the investor structure. So how did you initially structure it with the investors?
So what we do with our investors is, we usually do like a 70-30 split with our investors, and sometimes we have to do 80-20 depending on what the deal dictates. But in this case, it was a 70-30 split. I think we gave a 7 pref for our investors. And again, we raised capital from friends, family, and our investor base. And, I think this deal ended up filling pretty quickly because of the terms we're offering. And then I think on this one, we did do a 7-year hold, but normally we do 5-year holds.
Yeah.
On our business plan.
Yeah, we were very conservative with this one. We've already beaten our pro forma on this one.
And on this particular one with the investors, do you have any secondary hurdles in the waterfall or anything like that, or was it just a straight 7% pref and then 70-30 split?
Yeah, 7 pref, 70-30 split, and then the hurdle I believe was we have to hit a 20% annualized return. And then I think there's a step down to where over time, the GP starts getting more share. But we wanted to hit like a 2x multiple for our investors first. And that's usually our goal.
Good. And what was the decision behind doing 7 years versus your traditional 5?
I think it made sense,
right?
Yeah, it made financial sense at the time, it made sense when we looked at the pro forma. One thing that we assumed that the tax rate would go to its highest point on purchase, which is always, to your listeners, sometimes taxes can make or break a deal, right? You have to assume worst case scenario, underwrite worst case, and if you appeal and then you win the appeal, that's just gravy right there. So that's what we did. And that saved a tremendous amount of money because, we won the appeal. So that saves money there. And then there's other efficiencies that we put in place that actually save money. Our rent is higher than we expected. So we were just very conservative, when our initial pro forma, and it hit our 2x equity multiplier in 7 years. That's why we did it. And that's sort of like when we hit the 2x is kind of how we market the property is, because people like to see that, doubling their money. That's why we did it that way. But if, knock on wood, things continue, we could probably exit earlier than that.
Mm-hmm. That's great. So I got 2 final questions for you as we wrap it up today. First question is, what did you find that was easier during this entire process of this acquisition that maybe originally you thought was going to be a little bit more challenging?
I would say that.
Go ahead, Vic. You go first.
I would say maybe the due diligence and just do it, the kind of work that would be needed to do the property and sort of get it ready to take over and to actually execute. It seemed to have been a lot more, but the actual process was more seamless. And we've had some hairy deals in the past where we've had to do a lot of work. So it was nice to have a smooth operations, but I'll let Ravi speak on it too.
Yeah, I think what went easy for me was just the business plan, just implementing the business plan. I mean, it was seamless, and I thought it would be a lot harder than it was, and it went over very well. Thanks to our property management company, they did a lot of the heavy lifting.
I think that's the buzzword, Dan. Choosing the right property management company can make your life either hell or heaven.
Yeah.
Who were you using down there in Atlanta?
First Communities.
First Communities. Good. Mm-hmm. That's where they're headquartered, I think, is in Atlanta, aren't they?
Yeah. And then I think they have some presence here in North Carolina too, I believe.
Yeah. Last question for you two is, what did you find that was harder than expected during this entire process that maybe originally you thought was going to be a little bit easier?
I would say the raise, it was smooth and we ended up over raising anyway, but it was interesting because it was year end. And so there's all these dynamics of year end capital raising that's a little different than normal times. And so it's just something to be more aware of. Like some people are, investors are either engaged or really not engaged, or some people really want to get in because it's year end and they want to get some kind of financial incentive or tax benefit. And then other people are like, hey, I'm traveling, so can I fund it later, when I come back from a vacation? So it's that kind of dynamic.
Yeah, for me, I think it was just like looking at the pictures of the property before our renovations. It looked a little ugly, And when I looked at it on paper, I'm like, man, do we want to do this? It was sort of like that kind of, that kind of feel. That was the hard part, just kind of mentally getting over that and just realizing, hey, we're gonna wrap this nicely and we're gonna package it well. It's gonna look awesome when we're done. I think just kind of mentally getting to that point was a little harder for me.
I want to thank both of you for jumping on here and sharing all this information about this acquisition on our podcast. I've been meaning to get you both on here for a long time now. This is now 2 years that we've been doing our podcast now. So this is the first time we've had you on, and looking forward to continuing to follow you guys and being able to close more deals and be able to talk about more deals on the podcast. But before we wrap it up, I'd love for you to share with the listeners how they can reach out to you, how they can follow you more, and potentially join you on one of your future acquisitions.
Sure. So our website's vikingcapllc.com. And again, our company's called Viking Capital. We're on Instagram, Twitter, Facebook. So we're everywhere. And and if you want to get a hold of me personally, my email is vraya@vikingcapllc.com. And Ravi's is rgupta, RGUPTA @vikingcapllc.com.
And then we've got another site called, it's mdincome.com. It's mdincome, all one word.com. And that's just helping. We got this niche physician sort of market and, helping docs do what we do. That's another way to contact us.
Awesome. Well, again, thank you both for jumping on and sharing all this information and this advice for our listeners, and looking forward to having you on a future episode as you continue to close more deals.
Thanks, Dan. Great being here.
Yeah.